Samvardhana Motherson delivered a steady set of second quarter earnings. Margins were in line with the CNBC-TV18 poll. We're going to discuss this with the CFO, Kunal Malani. Kunal, great to have you with us here. Good morning. Thanks for joining us. I just want to start by asking you that the overall global auto OEM picture remains pretty muted, right? I mean, you can look at the guidance which companies like Volvo, etc., has given for 2026. They're actually forecasting a decline. So as you look into calendar 2026, what are your thoughts? What is the discussion with customers regarding tariffs? Have you managed to pass on the entire tariff costs? Let's just start there.
Hi, good morning. I think we do anticipate that a lot of the powertrain challenges or powertrain mix challenges that were there, the customers have taken corrective steps around those. And as some of the new launches happen, you should be able to see a better traction come back in the market. We do expect, for example, the H2 to look much better than H1, and then momentum should continue. Europe was a little bit of a miss for the last few quarters. I think that seems to have bottomed out. And again, we anticipate some amount of growth to come back in that set or that part of the world as well. So if you look at the overall volume expectations at the beginning of this year was around about somewhere between 88 to 89 million. That's already moved to the 90 million mark, and to be seen how it moves as we move ahead to FY27 as well. On the tariff front, I think the industry in general has been able to figure out ways to work with the revised, world dynamics, if I were to put it. And that's what we have taken in our stride as well. We have worked hard to be able to find mitigating elements together with trying and working with the customer to pass through some of these costs. Some of it has been done. We are still carrying around about 10 million of additional costs in our P&L right now, which should also be passed on as we move through the rest of the year. So overall, I think much of the not so good parts of the industry seems to be behind us. When we look ahead, at least things seem clearer. Things seem that if not, significant growth, it's still muted with a fair amount of content growth coming in, which should all aid in our growth. And on top of it, please do bear in mind, we're not only automotive. We've transformed ourselves to be a DEMA, which is design, engineering, manufacturing, and assembly powerhouse. And we are industry agnostic. So many of our non-automotive parts of the world, parts of our business, stuff like consumer electronics, stuff like aerospace, all seem to be moving towards a high double-digit trajectory for some time now. And will continue to do so as its order book is pretty robust as well. So hence many legs of growth as we look ahead. We're pretty positive as we look through the rest of this year.
All right. Hi, Kunal. Good to see you. When you mentioned about non-auto as well. We had Mr. Sanjay Parekh of Soham, who joined us on the channel yesterday. And he was talking about prospects of the company. So I just want to focus a little bit on that. It's still a very small part of your business, the non-auto. How do you see this part of the business scaling up? And will it be inorganic in nature, or will you do it organically?
We've never said either or. It's always and for us. As you know, we are a fairly acquisitive company. Right now, however, I think with the amount of order book that we have on the organic space itself, the absolute immediate piece is organic, though we continue to look at opportunity sets in this space as well. So you're aware that we are setting up our largest greenfield ever that we have set up for the consumer electronics piece, which should kickstart in the latter half of FY27. We are having new facilities come up in the aerospace side as well. There's one in the health and medical side now as well. So a large variety of investments being done right now to enhance the growth around this topic. And as we deliver more, there are enough number of opportunities at the global level that are also at play, which you will hear as we move through the rest of the year.
So it moves to what in terms of a percentage contribution as the facilities come on stream? First electronics facility has come on stream. Second one is coming on stream, and all of that. So non-auto, how much does it contribute by 27, 28, 29?
Difficult to guesstimate given we remain acquisitive. So if I give you an estimate and then tomorrow announce something, it will start looking very different, specifically if the announcement is on the automotive side. So, but needless to say, I would say that the non-automotive piece will be driving growth at a significantly higher pace organically versus the automotive piece. And hence, at an organic level, the share should consistently increase. The inorganics can change the share as we move ahead, and the inorganic can happen on either part of the business.
Yeah. And Kunal, hi, morning, which is why it'll really help because there's so many different parts to your business, right? And you're in so many different markets. It'll really help if you give us a sense of, not just for FY26, say looking at FY27 perhaps, on a steady state 12-month basis, the organic business across, all the lines. What is the run rate at which you think your organic revenue will grow? And again, margins, overall, which are about 6.7% as of this quarter. I'm talking about blended margins. What is the trajectory on a steady state 12-month basis?
So look, I think one, you should not ever view us on a quarter-on-quarter basis because there's obviously too much volatility that is embedded.
Yeah, which is why I'm asking for a sort of an annual outlook.
Yeah. So on an annual basis, as we have always maintained, I think our endeavor is always to do better than last. And I think that's what we will deliver most likely in this financial year as well. We should do better than what we did last year, both on top line and bottom line front.
So, but better than last year, Kunal, can also be 1%, right? But for investors, there's a huge difference between 1% and 5% or 9%. But some ballpark estimates, if not numbers, will it be single-digit growth? Will you aim for double-digit growth?
Look, there are many things at play right now. So it would be a little too early for me to really talk about it from a particular percentage of growth. Let me give a little bit different picture. Maybe if you think from an ROC perspective, we are today at somewhere around 14.5%. We should trend, at least a couple of percentage or more up as we move through the rest of this year.
And on margins, where this quarter there's been some pressure on wiring and harness, modules and polymer more or less steady. So again, I'm not asking for a quarterly trend because it can be volatile. You're across so many markets and businesses. But, when we talk about full year margins, would you be perhaps northwards of, say, 7-8%? I mean, just how is it looking? Or are you expecting margin pressure in the second half? And if yes, across which businesses?
So we are aware we are an ROC-focused company, so margins is not really what we focus on in that regard. But I would expect that, as the top line grows with our H2 looking better, the absolute value of our profitability should also go up. And that's what's giving me the comfort that ROC should track upwards.
Kunal, we'll leave it there. Good luck to you. Thank you very much for joining us and appreciate your time here on CNBC TV18. Stocks up about 3.5% as we speak.